Hi, Green Bean here. So, IAC released their Q3 earnings yesterday, and the stock price shot up for a little bit, and then it kind of went back down. Same thing happened to Angie. It was going up like 10%, and then boom, it just went back down to where it was. So, if you didn't know anything about IAC and you looked at the earnings, you would have thought they are actually pretty bad earnings, especially if you look at the revenue growth. But being an IAC shareholder myself, I actually think the earnings were pretty decent. So, what exactly is IAC? IAC, you probably never heard of them, but you probably heard some of the companies that they spun out. They spun out Ticketmaster, they created Match Group, Tinder, Vimeo. So you probably heard of those companies. So how IAC works is they buy up these internet companies they feel are underappreciated. They then proceed to fix them up to make sure that their revenue starts growing really fast and their earnings start growing really fast. And then at a point where they think the business is ready to stand on its own, they would then go and spin the company out. So they would issue the company in an IPO, and then they would give the shares to the shareholders through a special dividend. And that's how IAC works. They've been in business since 1995. And since 1995 to 2023, if you count all of the spin-offs, their value grew at 13% each year versus a stock market that grew 10% each year over that time. So they've had a really good track record of executing. Right now, IAC owns stakes in Angie, Dotdash Meredith. They own part of Turo, MGM, Care.com, a bunch of other companies, including Ask.com, Ask Jeeves. So they own a ton of companies right now. And the main reason I'm interested in this company is because right now the market cap sits at about 3.8, 3.9 billion. And I think the total value of the assets easily is over $10 billion. So I think it's a great opportunity. And right now, I think there's quite a lot of panic selling going on because IAC's properties, their internet companies, usually grow at about 10 to 20% each year. And it was doing that during the pandemic. But suddenly you look at the earnings and you see 20% drops in revenue and everyone's freaking out. And I think it's really interesting to look at this company right now. So revenues in this period went from 1.3 billion to about 1.1 billion. So that's a drop of about 15%. However, their operating loss actually narrowed. It went from them losing about 124.7 million to them only losing about 32 million. And adjusted EBITDA also went up as well. It went from 50 some million to over $100 million. And adjusted EBITDA, for all you non-finance folks, is earnings before interest, tax, depreciation, and amortization. Overall, the theme of these last few quarters for IAC really has been to narrow their losses to focus on breaking even before they can start picking up revenue growth again. All right, so let's go into a few facts about IAC before we start breaking down each of the individual businesses. So these guys have about $1.4 billion in cash, and about 800 million of it is attributed directly to IAC, and the rest of the 600 million is split up between the subsidiaries that it owns. So Angie has about 300 or so million, and then Dotdash Meredith has about the rest of the money. In terms of debt, they have $2 billion of long-term debt. None of the debt is attributed to IAC itself. So 500 million of the debt actually is Angie's debt, and then the rest of the 1.5 billion they got from the Dotdash Meredith acquisition. In terms of other interesting things, they have stock-based compensation each year of about $110 million, which is a lot, and it's the thing that I like about IAC the least, is they pay a lot to management for the work that they do. Couple recent developments. So IAC gave an update on some of their holdings. So they sold one of their assets, Blue Crew, in November of 2022 for about $132 million. Recently, they've also acquired about an 18% or so stake in MGM, which in this recent earnings, they value at about $2.5 billion. dollars. And their Turo stake, they've also increased to 31% recently. If you value Turo at about $2.7 billion, their stake comes out to roughly around 800 million or so. So first, let's go into Dotdash Meredith's results. So, little bit of history here. Dotdash is a property that was acquired from a company called About.com. And in 2021, IAC acquired Meredith properties for about $2.7 billion. And Dotdash Meredith is the world's largest print and digital publisher. So they own multiple different brands, including Investopedia, All Recipes, Spruce. They own People Magazine. They own dozens of online internet brands. And you probably interacted with them here or, again, somewhere else. So this is what we're going to be breaking down first. So Dotdash Meredith's results, their digital revenues went down 4%. Their print revenues went down 16%. However, their losses have narrowed tremendously. They went from losing 96 million, so they had an operating loss of that same time last year. And this year, they're only losing $4 million. And in terms of their adjusted EBITDA, which takes out depreciation, amortization, tax charges, that increased 119% to $68 million. So a couple things you need to know about Dotdash Meredith. So Dotdash Meredith has been struggling over the past year because of multiple reasons. The first is macroeconomic factors. So Dotdash Meredith owns a lot of properties, internet properties, that rely on discretionary spending because Dotdash Meredith makes a lot of their money from advertising on their internet sites. And if discretionary spending's down, that's going to hit them really hard. So they have categories such as in entertainment and health and investing, finance, and recipes, wines. And if people are spending less money because of the recession, it hits them really hard. And another thing that's affecting Dotdash Meredith a lot is IAC bought Meredith in 2021, and they're still trying to integrate that property together with Dotdash. But that integration process has been pretty tricky, and in the past year, they lost a ton of traffic as a result of trying to combine these brands together. If you take a look at the results, you can see Dotdash Meredith has multiple revenue streams. One of them is other companies paying Dotdash Meredith to have their ads displayed on their sites. So that revenue is down. They also have licensing revenue, which is retail providers being able to use Dotdash Meredith's brands in order to sell their products. That's been down as well. I mean, retail overall hasn't been in a very good position over the past year or two. However, their performance marketing revenue is actually up. Now, performance revenue is when Dotdash Meredith has ads on their sites, and if a consumer makes a purchase by clicking that ad, then Dotdash Meredith gets a cut of the profits. And the CEO mentioned during the earnings call that this is primarily driven by e-commerce. So this encouragingly has gone up by quite a bit. And part of it could be due to them launching an ads product called Decipher. So what Decipher does is an advertiser can use the tool, and let's just say they want to advertise for wines, let's just say. So Dotdash Meredith has a site that just has people reviewing wine. So then Decipher will say to them, okay, great. Well, the best channel for you to advertise through Dotdash Meredith is to use the wine site in order to promote your products. So Dotdash Meredith works very different from sites that use cookies because each of Dotdash Meredith's websites are very specific to a certain topic, such as All Recipes is for people who are looking for recipes, and Investopedia for people who are looking into investing. Because their sites are so specific, they can micro-target these ads. So if anybody wants to advertise in a certain category, they don't need to put any cookies on you. They know exactly which site to put that ad on. And right now what they're seeing is a lot of these ads that are related to e-commerce, they're actually experiencing a lot of growth, and in particular from Amazon, because Amazon has a partnership with Dotdash Meredith where people who sell their products on Amazon can use Dotdash Meredith as a way to drive traffic to make Amazon purchases. The other segment that's down for Dotdash Meredith is the print revenues, which are down 16%, and I don't think the management is going to do much to try to revitalize that. They are actually phasing out a lot of the revenues and business that's associated with publishing magazines, probably because Gen Zs don't really read magazines. One really interesting thing that I found in the shareholder letter is the fact that the negative traffic impacts as a result of combining the Dotdash and the Meredith brands together are going away. So if you look at this, for example, and I'm going to pull it up on the screen, you can see traffic has been declining over the past year, but recently it's finally started to tick up in the core Dotdash Meredith assets, which is the internet companies that IAC is putting the most amount of weight behind. In fact, in the recent month of October, they actually saw double-digit traffic increases in the core assets that I mentioned. So as a result of the negative impacts of the traffic disappearing, management is actually guiding that in 2024, you can expect to see revenue growth from Dotdash Meredith and profitability to continue to increase. Okay, so next we move to Angie. So Angie is a platform that matches homeowners with handy people. Essentially, if a homeowner wants anything done around the house, say they want to get their lawn loaned or they want to get their house painted, then they can just go on Angie and find a service provider to come do the work. So domestic revenues declined 14%, however, the international revenues went up 25%. However, their losses narrowed a lot. So their operating losses actually dropped by 9%, and they increased their adjusted EBITDA by 13% to about $26 million. So a little bit of a background on Angie. So Angie was made up of the combination of three separate companies. The first company is called Home Advisor. Home Advisor made their money by selling leads to contractors. So they would make money for each lead that they sold to the contractor. Say if a homeowner wanted to maybe get their house painted or their lawn mowed or something like that. They also merged Handy, which is a service sort of like a two-way marketplace where, let's say, a homeowner wanted to get their lawn mowed. So Handy would estimate that work to cost $600, and they would get a contractor to do the work for $600, but then they would charge the homeowner $800 and make a $200 profit. So that's the services part of the Angie business. And Angie was also includes Angie's List, which is a long-term company that's been around for a while, which is a platform for handy people to go and advertise their services. It's kind of like a directory for people to do different kinds of handiwork. So what's going on recently with this company is prior to Joey Levine, the CEO of IAC, coming also to be the CEO of Angie, Angie had a pretty bad rap, and specifically most of it came from Home Advisor. So there were a lot of complaints from the service professional side that Home Advisor would send them really bad leads, and they would still have to pay for these bad leads. And another complaint was that whenever a contractor got a lead, that same lead got sent to multiple different contractors. So then the homeowner would have multiple contractors calling them at the same time, and it would result in a bad experience both from the service provider because they would have to bid with multiple other providers, as well as the homeowners who are sick of getting called by 6 or 7 people for the same job. And if you actually go on YouTube, there's a lot of angry contractors venting their frustration at Home Advisor as well as Angie. And an issue with this bad experience that homeowners and service professionals have with Home Advisor, it's made it tricky for Angie to produce any kind of consistent profitability. So the CEO comes in and he takes drastic action. I mean, drastic action to cut any revenue that results in a bad customer experience, both on the service provider side and on the homeowner side. And this means making sure that the leads they're sending to contractors are actually of higher quality. But that means reducing the total amount of leads that they're giving to contractors, which takes a hit on their revenue. And they're also taking multiple hits on other areas as well. For example, some services that are difficult to estimate, or services that is difficult for the service provider to actually complete, Angie has stopped offering those kinds of services. So those are just two examples of the CEO really taking drastic action to cut any kind of revenue that results in a bad customer experience. So a lot of this also has to do with cutting down revenue that isn't profitable for Angie. So one of these areas is the roofing business. So they bought a company called Total Roofing to try to enter the roofing business, figured out that it was very unprofitable. They didn't have any competitive advantages here, and they promptly this quarter decided to sell that business, and I think that's a good decision for them. They're also trying to rely less on phone sales. So if you actually are familiar with Home Advisor, they cold call a lot of service professionals and they cold call homeowners as well. Well, the service providers cold call the homeowners. And this creates a bad experience all around. And what IAC is trying to do, or what Joey Levine is trying to do, is reduce the amount of times that owners and service providers are contacted via email or through the phone. And that's led to less service providers being onboarded, but also of a higher quality of service providers that do get onboarded. So this is going to take a short-term hit to revenue because a lot of the channels that they used to drive revenue before is being scaled back. But it's scaled back, I think, for a very good reason. And lastly, related to exiting complex services, they're also doing this because what they find is with complex services, they don't actually make that much money from it anyway. So they're focusing more on repeatable services that are easier to estimate so that there's less cases of a homeowner being told one price and then a contractor coming in and saying, actually, I can't do this work unless you pay me X amount of money. So a lot of work is being done really to make the enterprise more profitable and to improve the customer experience. And one of the things that Joey Levine says is he wants to transition Angie away from being a lead generation business, which oftentimes doesn't create lasting impressions with their customers. And he wants to transform Angie to a marketplace where the ideal homeowner can meet the ideal service professional and they can communicate via the platform and create a situation where they match two very well-suited people together. And it produces both a better experience and also better profits for Angie in the long run. So these efforts to transition Angie from a lead generation company to a marketplace, it hasn't really felt itself in the revenue yet because the revenue has just been dropping. Maybe they've seen a little bit in the narrowing of the operating loss, but they do track a lot of metrics that show that it's working. For example, the Net Promoter Score, which is how likely a homeowner is to recommend Angie to one of their friends, or a service provider to recommend it to another service provider, that NPS is going up. Another thing that's going up is the number of monetized transactions per each time the service provider gets contacted with the homeowner. So that's risen from less than 1 to 1.2, which shows that both service providers and homeowners are using Angie more, and it's resulting in more transactions that are monetized, which is a time when the homeowner actually bills the contractor, which is a win for Angie. And one really important fact is the fact that service providers are staying with Angie longer. They've improved their retention rate by over 40%, which is significant because a lot of service providers were complaining about how Home Advisor was sending them really bad, crappy leads. And it looks like to increase the retention by 40% means that they're reinventing that brand in the eyes of people who use Angie, the service providers, which is a significant step forward. Overall, I feel really good about the actions that management is taking. It's not pretty from a revenue growth perspective by any means, but I think this needs to be done. And management is expecting that soon they will get back to revenue growth, but they're not guiding a specific timeline because they don't want to sacrifice customer experience for revenue growth. But if and when the business is sufficiently restructured and revenue growth continues, it will be a much more profitable enterprise and a company that is more loved by its customers. All right, and lastly, we have the emerging and other category. So there's quite a few assets here. I don't know all of them, but the main ones are Care.com, which is a two-sided marketplace for people who need caregivers for their son or for their child, for the elderly. So it matches those people with caregivers. And there's another site called Vivian Health, which is a place for hospitals to find nurses. So those are the two biggest assets in emerging and other. And they have other things like the Daily Beast. They have Ask.com as well as in there, as well as some 50 or so or even hundreds of different smaller internet properties that they have. So the revenues here decreased 12%, and the operating income went from 3 million to 4 million, and the EBITDA went from 13 million to 15 million. So the main reason why the revenue dropped here is because they sold Blue Crew, which is a significant part of the emerging and other category, for 130 or so million to another company. So that's resulting in the revenues there being a little bit lower. As well, Mosaic Group is another company that they own. So this is a company that makes different apps. And recently they had to take a few write-downs in Mosaic Group. Although the value of the assets are so insignificant to IAC, I don't really think it matters all that much. But some of the apps that Mosaic built probably wasn't as profitable as they thought it was. But that's mainly the reason why emerging and other is having that negative revenue growth. I'm not too concerned though, because Care.com has grown 4% in revenue. Vivian Health actually grew 40%, which is pretty good. That could be the next big asset for IAC. But that's it for their performance for emerging and other. Another important piece of news in this earnings is that Angie and IAC actually is planning for Angie to buy back 14 million of their own shares because they see the Angie shares as being really undervalued. So that's pretty significant. It'll reduce the shares outstanding by around 3 or so percent, which is good for shareholders. So what do I think of the earnings? I thought it was a decent earnings. I think they're making a lot of good progress. For Dotdash Meredith, I'm really glad that they're finally seeing traffic tick back up again, and seeing double-digit traffic growth in October is a really good sign. And it's a good chance that Dotdash Meredith could be growing once again its revenue as well as its profits. Some people might not remember that Dotdash, that's before IAC acquired Meredith, was once valued at $1.9 billion. They were growing 20-30% each year. And Meredith is one of the most valuable digital publishing brands. So right now they're facing some short-term headwinds with integrating the brands together. But once they are able to combine it successfully, I think it could be a really big upside. And they're expecting to see this growth happen for the most part in 2024. And I'm excited to see what they can do there. I also like the progress they're making with Angie. I think this is more of a long-term play. In the short term, we might continue to see revenue declines, but I think all the work that they're doing is very right. They need to make sure they get the customer experience good before they start focusing on revenue growth. However, while this is happening, people are going to start panicking, start selling more Angie shares, and I might see this as a good opportunity to do some buying myself. So IAC is about a 10% position in my portfolio, and if it continues to trade at the levels it's trading now, I'm going to continue to buy up shares because I think it's a great opportunity. I don't think IAC really needs to do anything special for the value to be realized. It could be a Turo IPO, or it could be Dotdash reversing and going back into revenue growth, and it only takes one of those events for the stock price to move quite a bit up. But again, I'm not a financial advisor, but that's what I'm going to be doing with my IAC shares. So thank you so much for tuning in to this earnings presentation, my first one on this channel. If you enjoyed it, please give me a like, subscribe. It's good for the YouTube algorithm and helps me get to a point where I can monetize my channel. So thanks so much for the support. Thanks for watching, and I will see you soon. Green Bean out. Bye.